Thank you all for dialing in. We have a large number of people who have registered, and we will allow a moment for people to join. Due to the high volume of guests, we will not be taking questions from the audience and would ask that you please direct all questions after the call to your CBA Relationship Manager. I will now hand the call over to Adam Donaldson, Executive Director of Fixed Income and Rate Strategy at CBA. Please go ahead.
Thank you, Darcy, and good morning, everybody. As Darcy mentioned, my name's Adam Donaldson. I work in the dealing room as Head of Macro Strategy at Commonwealth Bank. Welcome to our May 2025 RBA update call. It's my pleasure today to welcome both Joseph Capurso, CBA's Head of International and Sustainable Economics, and Belinda Allen, CBA's Senior Economist, to provide us with an economic overview after the RBA's decision yesterday, with Joe here to focus on the current global economic environment, given all that has happened recently. We'll start with Belinda. As expected, the RBA decision yesterday was to lower the cash rate by 25 basis points to 3.85. Can you please give us your overall summary and response to the RBA statements and media conference yesterday?
Thanks, Adam, and good morning to everyone who's joined the call today. As you said, Adam, the RBA did cut the cash rate by 25 basis points yesterday to 3.85%. It was very much expected by both financial markets and the broad consensus of economists. In fact, when you look at the Bloomberg poll, 31 out of 33 economists expected a 25 basis point rate cut, and the two remainder had forecast a larger 50 basis point cut. And that was really after the data between April and May, particularly around inflation and wages, had come in line with RBA's expectations. Obviously had a deteriorating global situation as well. So no surprises on the rate cut itself. There were some surprises, though, in the tone of the statement and the RBA's forecast updates as part of the quarterly statement on monetary policy. So maybe just diving into some of those details that really fleshed out for us the shift in tone by the RBA and also made us to make some minor changes to our base case scenario for the RBA. But the overall shift in tone really came down to what the RBA is thinking about inflation at this point in time. And for regular listeners of the call or regular readers of our research would know that the RBA has very much continued with the line up until yesterday that there were upside risks to inflation. And in the statement yesterday, that was shifted to the risk to inflation have become more balanced. So for us, that means upside risk to inflation and wages growth now in the rearview mirror. The RBA's moved on. They're now much more comfortable. Inflation is moving sustainably back towards the target band. We now have headline inflation and underlying inflation back within the target band for the first time since 2014. And as a result, the RBA feels very comfortable to take the cash rate lower. They've said monetary policy is now somewhat less restrictive. So it's still in restrictive territory, and there are building risks around the outlook. So particularly the global situation where they've made some downgrades to their growth forecast for this year. They're now expecting growth of 2.1% at the end of this year, down from 2.4%. They've also made some small downgrades to inflation forecasts for trim to mean. They're now expecting that to be 2.6% over the forecast horizon. They've made some small downgrades to wages growth forecasts as well. They've lifted the peak in the unemployment rate. And all that was done on a lower terminal cash rate in the implied market forecast. So for us, that was the real telling point that we could see the RBA move the cash rate back down to neutral a little bit quicker than what we had expected. So as a result, we have shifted our base case scenario for the RBA to cut in both August and September. Previously, we had August and November, and also recognise that the July meeting is very much live from here just because of that shift in tone on inflation, the changes they've made to their forecast, and of course the lingering uncertainty around the global outlook as well. And certainly that came through the statement, and it also very much came through the press conference as well from Governor Bullock, where she really wants to move on from the narrow path philosophy that the RBA has held on to in the last couple of years. They've really achieved that. Inflation's down. The gains in the labour market have now been held on to. And I think that the risks around the downside are building. So yesterday they did consider a rate cut and a on-hold decision. They moved pretty quickly away from leaving the cash rate on hold, and also decided on a 25 basis point rate cut instead of a 50 basis point rate cut, but that was definitely put forward. So putting all those things together, certainly a dovish move from the Reserve Bank yesterday. It was dovish enough for us to make that small shift in our base case scenario, but overall we do have the total easing in this cycle down to 3.35%, roughly where we do expect the neutral cash rate to be. But I'll leave it there, Adam, for my overall thoughts, and happy to answer any questions.
Yeah, thank you, Belinda. Look, I think I have a couple of follow-up questions related to that. If we look at what markets are doing, we've seen a very big rally on the back of the news from the RBA, with the 3-year bond yield falling about 25 basis points, so kind of inserting an extra cut, and a terminal cash rate being priced somewhere around 3.05%. So a bit below CBA's forecast, and a little bit below perhaps what we think the RBA thinks a neutral rate is. But could you just elaborate on how you really assess the risks to that 335 endpoint that we've got in our numbers?
Yeah, it's a good question. So I think given the building risks around the global outlook, and also the fact that the RBA also thinks the global tariff war will be disinflationary for Australia as well, you can certainly see the risk of an additional rate cut this cycle, particularly when you look at the forecasts that the RBA delivered yesterday in terms of the market pricing they've used in their cash rate forecast. And I think also not only the global scenario, but also probably where the risk lies in Australia is a weaker consumer. So they made some pretty solid downgrades to the recovery in household consumption this year. That is something that we flagged a lot the last few months. We know our data here at CBA that we see in terms of household spending has not picked up as we had expected. We made some downgrades to our growth projections based on that as well. So it seems like we've really shifted over the last few months of risks being to the upside around inflation and wages and even the labour market, and now the risks are sitting on the other side. And I think that's definitely what the market seems to be pricing in, is the risk that offshore and even local factors could see the need for an additional cash rate. It's definitely not our base case at the moment, but it is certainly where the risk lies.
Yep, so reading between the lines there, it sounds as though 50 points of cuts to come at a minimum, but potentially more if some of those risk scenarios evolve. So probably not too much disagreement with the market pricing.
Yeah.
Can I ask just a little bit about July as well? So in terms of that pricing, there's about 2/3 of a chance of a 25-point cut priced in for July, so 16 or 17 basis points, which is quite a shift. What do you think? Well, firstly, I guess, why did the team choose to stick with August rather than move to July for the next move? And I guess ahead of that July meeting, what do you think are the relevant factors that could swing that one way or the other?
Yeah, it's a really good question, Adam. So it's been the focus of the RBA to look at the quarterly CPI prints, and that's the cadence that they've adopted this year to date, with them cutting in February and May after the quarterly CPI. The RBA, particularly when they've been focused on inflation so far this rate cutting cycle, has wanted to see that full quarterly CPI print before making that decision. So we feel they may want to wait again to see that quarterly CPI print before cutting. Obviously, the risk is definitely earlier based on the data flow. Between now and July, we do get 2 additional monthly CPI prints, labour market prints. And I think most importantly as well, domestically, is we will get the first quarter national account. Now, there's already been some downgrades coming through. That will give the RBA the fullest picture of how the Australian economy is tracking, and could also open the door for a July rate cut as well. And obviously between now and July as well, we'll get some more hard data on how the uncertainty in the global economy is transmitting its way through not only to Australia, but our key trading partners, particularly China as well.
Okay, good one. And of course, one of the other things there that comes just after the July timing is the expiry of some of the 90-day grace periods that President Trump provided to trading partners with respect to the tariff negotiations and potential increases there. So that's probably a good point to bring Joe into the discussion. We've been through a lot in the last few months in terms of these tariffs announcements, various ups and downs, and the market has gone along for a pretty bumpy ride at the same time. When you look through the period and take stock now, where are we at, and what key news are you looking for to sort of work out what the path is going to be for the global economy?
Yeah, good question, Adam. It certainly has been a big task just to keep up with the constant announcements on changes to US tariff policy. So there are a few things we can be reasonably sure of, and one is that we are past what I call peak tariff. So we estimate the peak in the US effective tariff rate was around 40% in April at the very height of the retaliations. And then following the 2 90-day pauses, we estimate the US effective tariff rate is now down to 17%. So that's a big climb down. But on China, it's around 40%. Now in Australia and most other economies, it's 10%. Now, in terms of where to from now, there are 2 issues to be aware of. The first is, this week is the halfway point of the first 90-day pause, where dozens of governments are negotiating with the US government. So the end of the 90-day pause is 9 July. So the US government has agreed only one trade deal, and that's with the UK. Now, it's not clear right now if Australia is currently part of these negotiations, but President Trump just recently said that he and Secretary Bessent will be sending out letters to each government about what the tariff rate will be. We think that the US tariff rate on imports from Australia will be around 10%, and 10% is what the US government has said consistently is the minimum rate that they're willing to agree to. Now, the second issue to be aware of, and this is beyond the next few months, is the outcomes of the numerous US government reviews of specific industries. These are what you might call strategic industries in the minds of the United States government. Some of these reviews are going to be completed in November, such as copper. For pharmaceuticals and semiconductors, it's December. For trucks and aircraft, it's January. Now, pharmaceuticals and aircraft parts are important Australian exports to the US. So the bottom line here is that uncertainty about US trade policy will remain with us for the rest of the year. That'll be important both for financial markets and corporates that are directly and indirectly impacted by US trade policy.
Okay, good one. And again, looking sort of through what we know and suspect we might find, what would you say the overall impact has been on our global forecasts? Is there a meaningful change to the outlook? Is there a meaningful change to China in particular, or other forecasts that could really impact Australia and the economy?
Adam, there definitely have been meaningful impacts, and there are two elements to think about here. The first is the direct and indirect impacts on trade, spending, and economic growth and the like. So we updated our global economic forecast a few weeks ago, and we chopped a 0.5 percentage point off our global growth forecast for this year from 2.9% to 2.4%. Now, that is weak growth compared to the long-run average growth of a bit over 3.5%. Now, we reduced growth in 2025 by between 0.5% and 1% for China, Canada, and the US, because we think they're the three economies under our coverage that will be hit most hard by this trade war. Now, the US economy slows because the tariffs are a tax, and the large increase in tariffs slows consumer and business spending. And China and Canada slow because the level of tariffs reduce their exports to the US. And of course, they also retaliated to the United States, and retaliation just makes the situation worse for them. Because remember, tariffs are a tax. If you retaliate with a tax, you slow your own economy down, particularly consumer and business spending, and that just makes the situation worse. Now, I mentioned there were two elements here. The second element is uncertainty. Now, it's very difficult to measure uncertainty, but it is important nonetheless. And we think we'll see the impact of this heightened uncertain business environment through reduced business capital spending and employment. Economists often call that second-round impacts. And if you do see these large impacts on business capital spending, and then the situation in the world economy, particularly for the two big economies, could be quite weak this year.
And is that something that, I mean, you're clearly going to be looking at the data and trying to assess very quickly, but is that the type of risk that could unfold quickly and, for example, take the Federal Reserve and others by surprise?
It certainly would. I mean, we're lucky nowadays we have a large amount of high-frequency data, in some cases daily data, so that really does give us quick insights into monitoring the pulse of the world economy. We learnt that during COVID to look at the non-official data. So things like jobless claims in the US out every week with those lag, that can really tell us whether US businesses are reacting to the high taxes they have to pay by reducing headcount. And if you do see that, then financial market participants certainly will take fright.
Okay, great. I think so far we've seen some of those big confidence effects, but we're just waiting on some of that data to see if those second round effects are coming through. Belinda, back to you. So thinking about that global backdrop, which was obviously at the heart of the RBA change in tone yesterday, what have we actually done to our forecasts on the back of global events? And do you expect to see much impact on the domestic economy or inflation off the back of this?
Yeah, thanks, Adam. So we have made some small changes to our economic growth profile here in Australia based on the growing global risks. But as I mentioned earlier, also some softer data we've seen for the Australian economy to date in 2025. So we did downgrade our GDP forecast for Australia for end 2025 from 2.2% to 2%, so a 0.2 percentage reduction in growth for this year. Part of that, as I said, was a softer household consumption outlook. What we've noticed so far in the data for this year is we haven't seen that recover as fast as what we have been expecting. Households are still preferring to save rather than spend. When we look at CBA data for the marginal propensity to consume out of additional tax cuts, it's sitting at a pretty low 38% at the moment, lower than what models would suggest it should have been. I think a lot of that more recently has been global uncertainty. We've seen that impact sentiment figures here in Australia, both through the consumer sentiment survey and also the business survey as well. So it is still very much a confidence impact at the moment, but we could well start to see an impact on the harder data soon. So a lot of uncertainty around business investment plans in this environment, some potential downside risk coming through there. And of course, the other major impact could be on China's growth outlook as well. And as Joe's just mentioned, there have been some downgrades there. So they're the key channels that we could see impact on Australia. And certainly the tone from the RBA yesterday is that they stand ready to act if we do see that downside scenario play out in the Australian economy. We do think the impact, similar to the RBA on the Australian inflation story, will be disinflationary. There is certainly room for us to lift our import concentration of certain goods from China if there is some spare supply coming through, particularly through cars. So that could have a deflationary impact through to the Australian economy. So they're the kind of channels that we're looking at the moment for the Australian economy. Still very much, as Joe mentioned, we've seen it in the soft data. We're yet to really see it in the hard data here in Australia. But we do think there is a risk, as I said, and we've put that in slower growth for this year.
Okay, thanks. Well, that helps to shed light on that change of tone from the RBA yesterday and how they're assessing the risk well. One of the reasons I think that has had such a big impact on thinking is because it was a stark contrast to February when everyone described the cut as quite a hawkish cut. My personal theory on that is that in February you were just ahead of a federal budget and just ahead of a federal election, and there was potential for a lot of spending to emerge through that process. And it always, I think, is uncomfortable for an RBA to have to be in the news and potentially thinking about rates in the midst of an election campaign. So they sent a pretty clear message for everybody to hold on and wait until May. But I guess that election and the budget have come and gone. Belinda, was there anything out of that process that impact on views?
Not really. What we are and have been highlighting as a result of not only the budget but the election as well is that there does remain, particularly over the medium term, a lot of pressures on the fiscal position here in Australia. There's a lot of spending to take place. We know the federal government wants to increase funding on areas like defence. There's still a lot of pressure on the budget from health, universal childcare, the NDIS, obviously an ageing population as well. So we are cautious that there has been a lot of spending put into the budget, and there's still a lot of spending pressures emerging, and yet a lot of the gains from upside risk to commodity prices are now behind us as well. So there will need to be at some point a conversation around, do we cut spending? Do we lift revenue? How do we go about doing that? And with the re-election of the government, it looks like at the moment it'll be very much steady as she goes. We know their policies, cost of living dominated the agenda in the first term. We're now kind of shifting away from that, and the focus will have to be, and we think we'll continue to move towards improvements around housing affordability, the energy transition, dealing with the fallout from the increase in the global trade war, and how does that all play out for the government. So nothing really in the near term that we think is going to impact the economy, but certainly in the medium term, a lot of pressures building and a lot of policies that will need to be focused on, really, as I said, to tackle that housing affordability, boosting housing supply, dealing with US and China, and that net zero transition. So no changes to our forecast based on the election, but just a lot of questions to come, I think, for the federal government.
Yeah, okay. You mentioned commodity prices there, so I'll get Joe to put on his international economist hat again and tech strategist hat. With what we've seen globally, what do you think the impact has been and will be on commodity prices, and particularly the Aussie dollar?
Yeah, good question, Adam. So, look, the background here is that the basket of commodity prices that are important to Australia has fallen by about 1/3 since the cyclical peak in 2022. Now, that fall in commodity prices has contributed to the weak Aussie dollar, which over that same time period has fallen more than 10 cents from 75 cents a few years ago. Now, China is the largest importer, the world's largest importer of metals, such as iron ore. So the price of metals depends in large part on economic developments in China. And as mentioned earlier, the trade war certainly will have a meaningful hit to the Chinese economy. Now, our forecast for the Chinese economy is weak at growth of only 4.6% this year. And that means that there could well be some more downward pressure on commodity prices. We've seen this from time to time in iron ore, and you've certainly seen global oil prices down a long way in the last few months. That's not just Chinese demand, of course. Equally, and this is where it gets interesting, if the Chinese government feels that it's going to miss its economic objectives for this year, then it will feel that it needs to provide more support for the economy. And one thing we've learned over a long period of time is the go-to for supporting the Chinese economy is an increase in spending on infrastructure. And infrastructure is very metal intensive, and a large increase in infrastructure spending could well be very supportive for metals and the Australian dollar later in the year. So the story here is that the worse it gets for China, the more the trade war hits the Chinese economy, and if it spills over to the domestic part of the Chinese economy, the more likely the Chinese government is going to intervene with support, and the better it could well be for demand for commodities, particularly metals, and that will be quite beneficial for the Australian dollar and, of course, the Australian economy as the year progresses. So you have this interesting idea here is that the worse things get in China, the more they may end up being better for Australia later in the year and into next year.
Okay, great. Time flies, so our half an hour is just about up. I just wanted to finish by asking you each just for a 30-second snap on what people need to look out for into the end of the financial year.
I'll start, Adam. I think it's just watching the data here in Australia, the inflation data, household spending data, and how that may be impacted from offshore factors, and that will obviously tease out the timing of the next RBA rate cut.
So for the global economy, the two data points here are inflation and employment, particularly in the US. The US, what goes on matters greatly for financial markets. So inflation and employment will give an indication of the impact of the trade war. They'll inform central banks on what they need to do next, and certainly give a strong steer to financial markets such as interest rate markets and exchange rate markets. So the soft data certainly turned bad in the US. But if we see it in the hard data like inflation and employment, then I think the volatility is going to return and things could get very interesting, Adam. Yeah.
Okay. Well, plenty to come. look, the next RBA meeting is in early July, and we're going to have our next call on the 9th of July. So for our audience, can you please pencil that in and reach out to your CBA relationship manager for details, or if you have any questions related to this call that you'd like us to follow up on. Let me finish by saying thank you very much to Belinda and Joe, thought-provoking as always, and good luck to everyone with the markets out there. Cheers.